expected 7.7% this year, which will be driven by stronger domestic demand. Let's bring in Ryan Felsman from Colonial First Aid Global Asset Management. And of course, my guest host today, Peter Escher from Invast. Ryan, great to have you on board. As always, let's start with the OECD. Kick off with the Australia forecast. Where do they sit with your own estimates?
Well, I think they're pretty much on par with the statement of monetary policy released by the RBA a week or so ago. So as you mentioned, Australian growth is expected to be around 2.6%. We're currently at 2.5% thereabouts. The RBA is forecasting 2.5%, so sub-trend certainly for the next 18 months or so. That's a fall from 3.2%, as you mentioned, in May in the OECD's forecasts. One thing that the OECD mentioned, of course, is the fact that they think that interest rates should remain low in Australia for the time being, certainly with the mining investment boom peaking. So that's pretty much in line with our thinking as well, although our view, of course, is that we think that rates remain on hold until about the third quarter of next year when they'll start to hike rates. Certainly, one of the things the OECD focused on were the downside risks. There was talk about unit labour costs in particular. So Australia's unit labour costs have surged about 54.1% since 2000, and that's largely been driven by an increase in the commodity boom and commodity prices in particular. And that's led to certainly international competitiveness from an Australian perspective declining relative to our peers. In the US, for example, unit labour costs have fallen by about 25.9% over the same time period. The other thing to note, of course, as well, is that the OECD warned around Australia's elevated house prices. Australia's house prices have increased during that same time period by about 79.4%, but that's surprising from the point of view that we're actually the fourth fastest growing economy from that perspective, behind New Zealand and Norway. And then, of course, the other component to all of this is around household debt. So our household debt was around 184% in terms of our gross disposable income, and that's the sixth highest in the OECD as well.
In terms of the forecast, as you say, pretty much in line with the latest monetary policy figures.
That's correct.
Below trend for the next couple of years, and then bang, come 2015, at 3.1% growth. What materialises then to see GDP growth take what is a significant uptick?
Well, I think the RBA is hoping, obviously, that the Australian dollar will fall certainly next year. We think that the Fed will begin tapering around January, if not next month, but perhaps March at the latest. Given that's the case, the Australian dollar should depreciate versus the US dollar, and we think it'll be moving back towards its 10-year average of around 87 US cents. So that will certainly facilitate our net exports in terms of its contribution to GDP. We'll also expect residential construction, which is currently at low levels. It's around 4.7% of GDP, and that's low relative to the 1980s when residential construction contributed around 7% of GDP. So certainly we think that residential construction will be around 0.25% to 0.5% over the course of the next 2 years in terms of GDP contribution. And of course, at the same time, there's talk about the housing market being stimulated through further infrastructure spend and the like. So we've talked about the debt ceiling being raised earlier. So the expectation is the debt ceiling will be raised by 60% to $500 billion. And that's predicated on the government issuing further debt. We saw yesterday a 20-year bond issuance, the longest on the curve. Demand was very strong. The yield was around 4.86%. And certainly, as a result of that, we should see potential for a 30-year issuance going forward. And that will mean that debt will be issued in order to provide the necessary means to and capital to fund our infrastructure spend. Joe Hockey's already said that he'd like to see cranes over every Australian city. So certainly that infrastructure spend would stimulate non-mining investment in particular.
Does it all happen, Peter, like clockwork for the RBA and these forecasts?
I think we'd like to hope so. I think there's a lot of hope out there that the residential space does pick up in terms of contribution to GDP to fill that gap. But I'm doubtful. I don't know. I don't see it. I don't feel it in the conversations that we have and the anecdotal evidence that we look for in terms of corporate reporting. We aren't seeing it yet. It's not to say that it won't materialise. The problem is that there's a lot of hope that it will materialise. But as of this point in time, I'm doubtful. I hope I'm wrong, but I'm doubtful of the numbers, the composition, the proportion of composition needed to offset everything else. So look, let's wait and see. This whole process of fiscal and monetary policy working to cushion does not always work in perfection. There's lagging indicators, and my biggest fear is that we'll be caught with a time lag sometime in the first half of 2014.
Ryan, I mean, is it fair to say that's happening to some degree now, that we're not seeing the transition happening as quickly as the likes of the RBA and certainly the government would like?
Yeah, certainly there's a lagged effect in terms of the transition. As the RBA has mentioned several times now, the Australian dollar is uncomfortably high from their perspective, around 95 US cents. So what we need to see is the Australian dollar come down a little bit, and it'll act as a shock absorber between certainly the mining and non-mining components of the economy. But at the same time, Deloitte Axis Economics has projected non-mining project spend to be around $275 billion in terms of committed, unplanned and actual projects coming to fruition going forward. So, you know, they're reasonably positive about the non-mining sector, and certainly the RBA in the minutes yesterday seemed reasonably upbeat about certain components of the economy, particularly they're seeing some evidence of retail sales picking up, consumer spending picking up in particular. So just in terms of the communication recently, there seems to be a bit more of a positive view around the non-mining sectors of the economy. But certainly it's going to take some time, and of course it all needs to be complemented by an improvement of business investment capital expenditure. We get that data for the September quarter on the 28th of November next week, so they'll be watched with a lot of interest in terms of intentions going forward and the like. So going forward, we expect certainly the domestic activity to continue to pick up, but we need business conditions and hiring intentions around that to pick up at the same time as what we're seeing the consumer situation improving.
And just quickly, we're almost out of time, but does the RBA get the wish of the weaker dollar helping to promote, if you like, the non-mining parts of the economy?
Yeah, look, I think the US dollar has commenced a long-term
uptrend
turn. Yeah, I think it's in the very early stages of a recovery, and I think we will see some type of tapering between now and March.
Oh yeah,
probably in March, and that'll be enough. You have a look at what Guy Debelle was saying today, basically admitting we can't do anything, we just need to wait and see.
We're going to hear from Guy Debelle after the break, which reminds me, we have to take a break.